Welcome, everyone, to our comprehensive guide on shareholder equity and book value. In today's dynamic financial world, understanding a company's true worth is paramount. Whether you are an investor, a business owner, or simply someone keen on making informed financial decisions, this video will demystify these crucial financial concepts, providing you with the tools to better assess a company's net worth and valuation. We'll explore what makes up shareholder equity, how book value is calculated, and most importantly, why these metrics are absolutely essential for anyone looking to navigate the stock market or grow their business. By the end of this session, you'll have a solid foundation to confidently analyze a company's financial health and potential for growth. Shareholder equity represents the total amount of money returned to shareholders if all the company's assets were liquidated and all its debts were paid off. Think of it as the owner's residual claim on the company's assets. It's often referred to as owner's equity or net worth. This figure is crucial because it signifies the capital shareholders have invested, either directly through purchasing shares or indirectly through retained earnings. It essentially illustrates the health and financial stability of a company from the perspective of its owners. Understanding this gives us a clear picture of how much of the company is truly owned by its shareholders, free from liabilities. Shareholder equity isn't just one number. It's comprised of several key accounts. The primary components include common stock, which represents the par value of shares issued to investors. Then we have additional paid-in capital, or APEC, which is the amount investors paid for shares above their par value. And perhaps one of the most significant components is retained earnings. This is the accumulated net income of the company that has not been distributed to shareholders as dividends, but instead reinvested back into the business. There's also treasury stock, which is shares the company has bought back from the open market, reducing outstanding shares. Together, these elements paint a detailed picture of how a company's equity is structured and what resources are available to fuel future growth. Now, let's turn our attention to book value. In simple terms, book value refers to the net asset value of a company, calculated by taking the total value of its assets and subtracting all its liabilities. Essentially, it's a direct reflection of shareholder equity on a per-share basis when calculated for individual shares. If a company were to liquidate all its assets and pay off all its debts, the book value per share is theoretically what shareholders would receive. It's a historical cost measure, meaning it reflects assets at their original purchase price, less depreciation, rather than their current market value. This distinction is crucial, especially for companies with significant intangible assets or those operating in rapidly appreciating or depreciating markets. Let's get practical with the calculations. For shareholder equity, the formula is straightforward: assets minus liabilities. Imagine a company with total assets of 500 crores and total liabilities of 200 crores. Its shareholder equity would be 300 crores. For book value, it's essentially the same total equity figure. However, when we talk about book value per share, we divide this equity by the number of outstanding common shares. So if our company has 300 crores in shareholder equity and 100 million common shares outstanding, the book value per share would be 30 rupees per share. These simple calculations provide a fundamental baseline for assessing a company's foundational financial strength and can be found directly on a company's balance sheet. So why are shareholder equity and book value so important? Firstly, for investors, a higher shareholder equity generally indicates a financially sound company with a strong asset base relative to its debt. It provides a margin of safety. Secondly, book value per share is often used as a benchmark for valuation. When a stock trades below its book value, it might suggest it's undervalued, presenting a potential buying opportunity. However, it's not a standalone metric. It's particularly valuable for industries with tangible assets, like manufacturing or real estate. It helps determine if a company has a solid foundation, can withstand economic downturns, and has the capital to invest in future growth without excessive borrowing. While invaluable, shareholder equity and book value are not without their limitations. A significant one is that book value is based on historical costs, which might not reflect the current market value of assets. For instance, a tech company's most valuable assets are often intangible, like patents, brand recognition, or intellectual property, which are not fully captured by traditional accounting book value.
Furthermore, a low price-to-book P/B ratio might indicate undervaluation, but it could also signal underlying issues or a struggling business. Therefore, it's crucial to use these metrics in conjunction with other financial ratios, industry analysis, and qualitative factors to form a holistic view of a company's true worth and prospects.
In conclusion, shareholder equity and book value are fundamental concepts that provide critical insights into a company's financial health and its underlying worth. Shareholder equity is the true owner's stake, while book value gives us a per-share measure of this net asset value. While they offer a solid foundation for analysis, always remember to consider them within a broader context, factoring in market conditions, industry specifics, and other financial indicators. By mastering these concepts, you empower yourself to make more informed investment decisions, better understand business valuations, and ultimately steer your financial journey towards greater success. Thank you for joining us today. Keep learning, keep growing.